How to trade market gaps. If you are trading or at least analyzing markets, you have seen that for like 90% of the time, markets have some sort of patterns and some sort of calculated movements. They are going in the range, they are going upper, they are going higher, but they have like natural sequences of numbers. But then all of a sudden there is some price gap and markets are simply making whole. And if you're looking at trading charts, you will see something like upwards move, some hole, and then markets open way lower or way higher than the previous time. It happens through different markets, it happens through different time frames, and you could see market gaps 50 years ago, and you could see market gaps even that on something like euro against dollar, where we had simply enormous liquidity. So yes, gaps are part of the trading. The question is, should you trade them or should you avoid them? Well, before understanding that, let's go slightly deeper in this issue and understand a bit better what market gaps are. Well, simply, market gaps are really fast price movement, and there is simply no way how the markets could actually make some ordinary sequence, and simply markets went from one price to another. So there is nothing fancy about it. It's actually as simple as there is. But what is not that simple is reasons for these price gaps, because they might be different, and you have to understand not the gap itself, but reason behind this gap. So first things foremost, in majority of cases, the reason is some sort of fundamental event, or in other words, some unknown news. For instance, if you trade currency pair, there might be some news over the weekend, and once currency markets are opened again, there might be huge price gap in one direction or another. That's most usual occurrences. Other occurrences might be with stocks, for instance, when stocks have ended their trading session, and after trading session, major financial reports might be published, and then in next trading session, there might be gap out upwards or downward direction, dependent whether this financial report was good or bad. And actually, that's the reason why many important events in global economy happens over the weekend, or why companies publish their financial reports after trading sessions. Because actually, if market opens with a gap, that means there is smaller volatility than it is if those events were at live trading markets. And I will tell you a reason for it. That is because there is a good strategy to it that calls filling the gap, and this is actually the ways you could actually start to trade with it. But let's just not go right into gap trading that fast. Let's discuss these gaps slightly more. And here's the thing, gaps also are dependent on the time frames should you use. The larger the market, the more liquid the market, and the larger the time frame, the less chances that you will have gaps. Because let's compare, for instance, daily chart with euro against dollar and some stock with really small market capitalization. Euro against dollar daily chart might be impacted only by huge global events such as COVID and wars, or simple economic disasters in one or another global economy, if that happened over a weekend. Actually, some years ago, when there was Eurozone debt crises, then there were huge gaps in euro against dollar because there were a lot of important meetings in Eurozone happened over the weekend. But these are only rare exceptions. In most of the time, that market will be with little gaps. But then again, there are small stocks, there are small altcoins, there are small currency pairs. And then even regular events could have huge impact. And if simply there is no liquidity, then there might be huge gaps all the time. And if the market is with too many gaps, it actually will be really difficult to trade. Because here's the thing, if you wanted to open or close your trade with specific time range, and these were actually filled by not prices but gap, you will get the best price above or below that gap. So that means either your trading order or your stop loss order or your take profit order shouldn't be filled at your prices, but at the prices which market allows you to trade. So this is double-edged sword. Not only you could trade gaps, but gaps might work into your disadvantage. So this is question about those not particularly liquid markets which are filled with gaps. But I would suggest you not to touch them if you are a beginner. For a beginner, look at gaps where we have more established markets. But now let's see one example of this. Here we have euro against dollar in 15-minute time frame. 15 minutes, because here you will see gaps better. And what's the usual pattern of currencies? Usual pattern is that on the weekends currencies are closed, so it closes on Sunday and opens at Monday. If nothing happens, prices are almost at the same levels and there is nothing interesting. But here we saw that at November 1st, prices closed at 1.08 and 34.4, and then they opened at 1.08809. So here we had gap with some decent pip movement here. So typical trade is to trade by filling the gap. So that means if market opened at gap, we probably should go short and to trade with that filled gap in our mind. Now, I sometimes traded it, I sometimes do not trade it, because this is the strategy which I would say is more for me analytical and for specific trade confirmation rather than trade initiation in my case. But here it worked. Here market actually risen for quite a time, but it worked. But you see, it was only after a couple of days, and then you actually had good downwards move as well. So gap trading works, but here without additional context, it's safe to assume it's relatively risky to do it. Thing is that you have to pinpoint also specific fundamental event and the reason why this gap actually happened. And here's the thing, if you want to trade these kinds of gaps, you have to know why that gap actually happened. So if you know fundamental reason behind it, you have specific level at that gap point, and you could establish clear stop loss level, and that risk reward between potential gap fulfillment and stop loss is at least 1 to 2, then you might actually trade it. But without that context, it's really difficult and dangerous to do that, because if there was real fundamental reason why actually market moved in huge gap, for instance, you might have stock you wanted to trade, but it opened with huge gap way lower, and you didn't know why that gap was actually there, and you went long, you might put yourself into danger, because the reason why market opened that lower was very bad financial result. And if fundamentals were really bad, then you shouldn't trade on that gap fill. So that's the most important thing you have to remember. Always understand reasons for your trade, and only then you might feel it. But here's the thing, if you want to see how this type of trading and other type of trading with gaps and similar market irrationalities goes with professionals, and if you want to see dozens of examples with trading like that, join my free Telegram channel, because there you will see comprehensive trade analysis, trade execution, and ways how you could actually trade it for free. And also you will have free signals that you could trade right away. So all you have to do is visit my link below the video, join me, and you could start to trade right away. But now let's wrap all this up. Gaps are inevitable part of trading. It happens with most liquid markets and with smallest markets. And actually, gaps are good trading possibilities for you, but you shouldn't trade markets with overly large amount of gaps, because gaps might destroy your trading positions and trading orders, because your orders wouldn't be filled if there is gap between your buying and your selling price. So here's the smart thing to do. If you want to trade gaps, trade only the most liquid market. Know why there are reasons behind this gap. And if you specifically know the reason by this gap, and you know that this is some sort of short-term noise which wouldn't impact long-term fundamentals, then you could make trade by filling this gap. And to do that, you also have to have top-notch stop loss levels that will have good risk reward for that gap trade. And in this way, you might trade gaps really efficiently. And of course, thanks for watching this video. Make sure you are following me rest of my content and join my Telegram channel.